Hello and welcome, TrendSpider users, to video number 3 in this educational series from GoNoGo Charts. My name is Tyler Wood. I am a CMT charter holder, and today, as always, I'm joined by Alex Cole. How's it going, sir?
Fantastic.
Awesome. Let's dive right into today's lesson. Today, we're talking about momentum concepts in technical analysis. And as we discussed in the first two videos, what we're really after is a defined, repeatable, disciplined approach, a checklist, if you will, to gather the weight of the evidence for some conviction in our trading discipline. And of course, as we discussed before, with a greater checklist, with a more sophisticated approach, we can reintroduce a lot of subjectivity through that analysis paralysis. So we want to develop some rules that will be very consistent. But before we dive into how we can do this with GoNoGo charts, Alex, let's just talk generally about why momentum concepts are so important to investors and traders.
We like to talk about momentum as examining the velocity of price movement, right? How fast has price moved in any one direction? And is that sustainable? And momentum oscillators can give us some insight there. We talk about a car accelerating as it gets onto a highway, and a car can continue to get faster, but it could be getting faster at a slower rate as it gets near highway speeds. And that's what we're looking for really with momentum. We often see price moving higher, but momentum not confirming with higher highs. And we'll talk about some of these concepts like divergence and areas of extreme swings. We call them overbought and oversold levels. But you can see that if we add these multiple panels of indicators to our chart and think back to the videos we just did, hopefully the videos you just watched where we were identifying trend, now we're adding 4 or 5 panels to a chart that leaves you much less able to see what's happening in the price panel, and perhaps complicates the chart too much and leaves you suffering from that analysis paralysis.
Absolutely. And what we're going to talk about today is that interplay between the price action and these momentum indicators. And momentum is a forward-looking indicator, right? We're looking in arrears. We're looking at price history when we develop trend models. And so it's helpful to have a forward-looking mechanism as well to spot those areas of exhaustion or potential pause for a security in trend. So what we're going to do today is go through a few examples, and I apologize in advance if we didn't pick your favorite momentum oscillator, but just to give a sense of the diversity of tools that are out there and some of the ways that traders can use them. So to get us started, let's go with the most simple form ever of looking at momentum, and that is simply the rate of change, right? Price rate of change measures the momentum by looking at the percentage change in price over a current bar and a specified prior period. Now, rate of change indicators are unbounded. We're going to talk about both bound and unbound indicators today. Unbounded just means that the rate of change can accelerate into infinity. And we saw some very caricature-esque examples during the meme stop craze of 2021, where the data became so distorted because price moved so fast and so far so quickly. So with unbounded indicators, you have less of a consistency with the data that you're looking at. The other important thing to look at is the slope of our momentum oscillator. Is this turning upward or turning downward? Is it positive or negative? And so for a rate of change, we're just starting with at this 0 level. We can go negative or we can go positive. And then there's this concept of divergence. We're going to talk a lot about that today. And that is the idea that as price continues to climb higher, right? We have higher and higher price points. We're seeing in our momentum oscillator, which is still positive, it's making a lower high. Now, this is a bearish divergence, right? We're not seeing confirmation of this new higher high in price from our momentum oscillator. And all that's telling us is that the buying is becoming exhausted, right? That perhaps this trend may take a pause. That doesn't mean it's an absolute sell signal, but it's giving us a forward-looking indication of where that trend may be reaching a point of deceleration. And then, Alex, let's move on and talk about a few other examples.
Yeah, this is the commodity channel index. And the commodity channel index is different from what you just described because it now compares price to a historical average of price. And you can then sort of get a sense of how far have we moved away from that historical price average. And what's important to note here with something like the commodity channel, as you mentioned, some of these are going to be bounded, some of these are going to be unbounded. This one's another one that is unbounded, and that means that it can stray very far from zero for some securities or not so far for others. And that's why it becomes important to look at each security on its own merits and say, okay, well, how far away from its moving average does this security tend to go? And then that reintroduces, Tyler, the problems of subjectivity, not having something we can properly compare from one security to the other. So we'll move on if you want now, and we can talk about some of the other oscillators. But again, even in this one, overbought and oversold, concept of divergence. So when we see those peaks in the oscillator and the troughs in the oscillator, we'll expect them to line up with some intermediary peaks or troughs in price. And divergence, incredibly important again. And one thing to note here, we didn't see this bullish divergence. We saw the later bearish divergence on ROC, but we didn't see the bullish divergence that we've got highlighted here. So now, which indicator should I believe?
Absolutely. The subjectivity comes back. Why don't you do another one, Alex?
Yep, absolutely. So now we're talking about stochastics, and stochastics was developed by George Lane in the 50s and has been a hugely popular indicator, you know, right up there at the top of the list in terms of which ones people add to the charts. And again, this one, all of these calculated slightly differently, which gives us, you know, value. Each one gives us value. The way we look at stochastics to get a sense of whether a security has been overbought or oversold is to compare price to the highest prices for a range. So if we would imagine that if we are in an extreme movement of price, then the stochastics reading would be high. We would be saying that price right now is the highest it's been for a period of time. And that's the way that the stochastics is calculated. Now, just like all of the others, we're going to be looking for areas of overbought and oversold. They're different for each of these. Stochastics, we use the levels of 80 and 20 for our overbought and oversold levels. And stochastics has a signal line as well, right? We have two lines in stochastics, the percent K and the percent D. You know, we can read up about what these are rather than go into the full calculations. But when we're looking at stochastics, we have two lines, and we can look at the crossovers between those lines for indication of waning momentum or increasing momentum. If we've got percent K crossing up over percent D, slightly bullish, or bullish, I should say. If we've got percent K crossing down over percent D, then that would be more bearish. Now, I'm sure you can see here, we have only highlighted some of the ones at extremes that line up with turnarounds in price, but there are a lot of crossovers here. So you might have to subjectively filter those. Perhaps we only look on a certain side of the trade if the oscillator and if the stochastics levels are above zero or below zero. It might change how we read those signals because there are a lot of them.
Absolutely. So here we might be looking for a mean reversion strategy where price has been downtrending. We see that percent K crossover, percent D, same crossover back here, but it's in an overbought territory as described by the stochastic oscillator. So do you take those if you're a trend follower and looking to buy high momentum securities? Maybe yes. If you're more of the mean reversion disposition, perhaps no. Again, introducing some subjectivity and a change in how you might code up those rules. So let's move on to perhaps the most widely used right now oscillator out there, which is Wells-Wilder's RSI. The relative strength index, not to be confused with the concept of relative strength, was introduced to the markets in 1978. And Wall Street owes this gentleman a great debt of gratitude. But I think oftentimes people misinterpret the use of momentum oscillators specifically for that mean reversion trade. And if you think about where US markets were in the 1970s, we're in a very difficult range-bound, choppy mess and a bearish trend overall for the decade. So when Wells-Wilder introduced RSI, a lot of folks started using that to spot those points of trend reversal and thinking that an overbought level meant sell and an oversold level meant buy. There's been some great work done interpreting George Lane and Wells-Wilder's work. I encourage all of you to do some homework, but that was absolutely not the intent of these original grandmasters and innovators, but instead to spot points of potential exhaustion. And as Ralph Acampora taught me about momentum, things can stay oversold much longer than you can stay solvent if you're looking for that mean reversion trade and happen to jump in early. So all we're doing with an RSI is comparing average gains to average losses, and we're looking at the magnitude of up days versus down days to calculate this indicator. Same idea, overbought, oversold, as well as divergence can be used here as well. And finally, another interpretation, some people call the money flow index the volume weighted RSI. So now we're incorporating volume into the momentum oscillator for a different sensibility about how much participation the market has, both from a momentum and a volume perspective. Here we're just highlighting a couple of those overbought and oversold areas. But again, be very careful about how you interpret the usage of overbought and oversold. The other challenge with a lot of these indicators is defining what is overbought and oversold, right? If 80 is overbought, what about 79? What about 81? Is there a significant difference there? So again, it leaves a lot up to interpretation by the individual trader or investor. So Alex, let's talk about this in context.
Yeah, so let's go back to that chart we looked at the beginning. Again, we know we get valuable information from momentum oscillators. We know we can look for areas of extreme price swings, and we can look at them in terms of overbought and oversold. We know we can find divergence from price movements or even confirmation from price movements. But I think that what the real comment here is that in order to do that, we need to reintroduce some sort of disciplined approach to make sure we don't get confused. As we noted in this presentation earlier on, ROC wasn't giving a bullish divergence at a certain point in the chart when other things were. So what do we do? Do we need to say 3 out of the 5 need to agree? Do we need to wait for all 5 to agree? Then there's the problem of having too much on the chart, leaving us unable to look at important price levels because the price panel is so small. Then we take what we've learned from momentum and we add it to what we learned about trend identification. And now we've really got a case of unable to see the forest for the trees, perhaps. So if we move on to the next slide, we want to introduce the GoNoGo oscillator. What we've done here is take all of the information that we find people using that's the most robust, most tested, some of those core concepts of momentum, and blend it into one oscillator, just like we did with GoNoGo trend. So we have one oscillator on the bottom of our price panel that gives us the information we need, Tyler.
Now this is range bound from -6 to +6. So already we're simplifying the way that we can read and interpret the oscillator. The other elements of this are that it can be used in the exact same way that we would use traditional oscillators. We can identify areas of overbought. In our case, that would be readings of 5 or 6. We can also look at oversold levels, -5 or -6. What's really unique about the data visualization is that we can look at volume on a relative basis. So this oscillator moves from a light green with average volume to a dark blue with heavy relative volume. So you can see more participation from the marketplace with that volume reading built right into the oscillator. We also can use this in the traditional way of identifying divergences, right? So here's a bearish divergence where price made a new high and the oscillator made a new low. In fact, it broke below our neutral, our absolute zero line into negative territory, came back to retest and was rejected lower. So the GoNoGo oscillator is going to simplify what we are seeing on our chart by not looking at many, many oscillator panels, but we're still going to be able to capture that information, that weight of the evidence, if you will, and incorporate that into a single oscillator. So thank you all so much for tuning in to this third session in the educational series. We're looking forward to having you back for episode number 4, where we're going to talk about how we can use oscillators in a trending security and the importance of that zero line. If you have any questions for us, by all means, reach out. You can always reach Alex and I at info@GoNoGoCharts.com. Until next time, take care of each other and trade them well.